Okay. So now let's try to understand what kind of differences can be created based upon income tax rules and GAAP, which is generally accepted accounting rules. So one of the important differences which can be created is a permanent difference and other one is a temporary difference. Now this entire chapter will cover permanent difference and temporary difference. Let's try to understand about the permanent difference through a real world example. So we will read through the concept also. Now, permanent difference is, let's see the example first and then we will come to the thing. So assume that a JP Morgan Chase company earns $100,000 in interest from New York State Municipal Corporation bond. Now, this company has earned this $100,000. Now, in your books of accounts, in your GAAP books, you will show this income, right? You will say, yes, I will show. So, this municipal bond interest will be shown as a revenue in your books of accounts. But as per IRS income tax rules, what will happen? This is not a taxable income. Why? Because the bonds income is not taxable as per IRS. That is their rule, and you will read this entire taxation concept in your other CPA modules. But there is no tax, so you will say there is a difference of 100,000 here. Now, tax impact, what will happen? You will say this is included in your net income when preparing the GAAP financials, because GAAP only cares about income, expenses, debit, credits. But in your IRS, you will say this is excluded from your taxable income because no tax will be charged. So what will be the result of this? You will say company avoids paying 21,000 in taxes. Why? Because the tax rate was 21% and here zero income was shown, so zero tax was shown. Or here $21,000 tax is there, but company don't need to pay this. Why? Because there is no taxation as per IRS on this. So you can say company avoids paying this 21,000 in taxes forever. Why forever? Because this is a permanent difference. Company will never have to pay taxes on these bonds. That's the reason we call this as a permanent difference. Now what will happen? Since this difference never reverses, this difference never reverses simply means that you never or you will never need to pay taxes on this income. No deferred tax assets or liability is recorded. Why? Because you don't need to pay any liability in future despite having this income in your books. So you don't need to create deferred tax assets or deferred tax liability. So the company simply reports a lower effective tax rate for the current period. This is a different concept, but effectively the tax won't be 21%, it will be quite different. So this is one of the example of permanent difference. Let's see another example of permanent difference of dividends, wherein what happens, this company Berkshire Hathaway, major shareholder in public companies like Coca-Cola and other company. So this Berkshire Hathaway has invested their money in many companies. Now, when a corporation owns a stock in another US corporation, the tax code or income tax law or IRS in US allows a dividends received deduction to prevent triple taxation. Basically, what happens? This Berkshire Hathaway has invested money into Coca-Cola. Now, Coca-Cola distributes dividend to Berkshire Hathaway. So, Berkshire Hathaway gets money. So, when they receive this money, they should be taxable, right? But what happens when the Coca-Cola prepared its financial statement, then they have already paid taxes on their financial statement for whatever money they have earned. But later on, this money is distributed as a dividend to Berkshire Hathaway. So Berkshire Hathaway also, if they pay the taxes on the same income on which Coca-Cola has already paid, there will be double taxation. So to avoid that double taxation, US corporations are uh, encouraged that there won't be any tax when a dividends received deduction is there, or I can say dividend is received, no tax is there. There are explanatory rules for that we will cover later. But yeah, this deduction reduces taxable income but is not an expense for GAAP. So basically, in GAAP, the treatment will be different. So let's see that thing through example. Like this Berkshire Hathaway receives $1 million in dividend from holdings. Now, based on ownership percentage, they are eligible for 50% DRD. This is a rule, but what this simply says that as per income tax, out of this 1 million, only 50% dividend received deduction will be there. It means that tax will be paid only on remaining 50%. This is the rule as per IRS. Now, what will happen if you see your books of accounts? You will say in GAAP the dividend will be shown as 1 million. In IRS the dividend will be shown as 1 million as well. But in GAAP, do you get any dividend received deduction? There is no such kind of thing like dividend received deduction in GAAP. So there will be zero expense here. Okay. But in IRS itself is saying that out of this $1 million, you don't need to pay taxes on 50% because this is dividend received deduction, and these rules are mentioned in detail in IRS. Now you may ask that there may be a lot of hundreds and thousands of rules. Yes, I can say, but in your CPA examination there are limited rules which we will cover in this chapter, so you will know those rules before the exam. Now this $500,000 they have given as deduction. So you will say as per GAAP our income will be $1 million, but as per IRS our income will be $500,000. So what will happen? Result is like Berkshire pays taxes only on half of the cash received. They are paying taxes only on $500,000. And now the accounting treatment is simple. This is a permanent saving. Why? Because this tax won't be required to pay even in futures. So you will say this will only affect the current tax computation and does not create any deferred tax balance. No deferred tax assets, no deferred tax liability. This is also example of permanent difference. Now let's see the summary for this. What the summary simply says that, or I can think that summary you can read through, so there is nothing very much different against what I said. So let's go through the textbook concept wherein these things are written. Okay, so textbook simply says that permanent differences are items of revenue or expenses that are recognized for either financial reporting or tax purpose but not both. So they are in either financial reporting or tax purpose but not in both. Now what are the types of different permanent differences? So this one type is like included in pre-tax GAAP financial income but never in taxable income. So on these items you won't pay tax anywhere or anytime. So you will say the example is interest income on state or municipal corporation bond. If some company earns interest on state or municipal corporation bond, they won't pay income taxes on that. But in GAAP, that will be shown as the income. Next example, included in taxable income but never to pre-tax GAAP financial income. Now the dividend received deduction is one of the example what we have seen above, and the detailed rules for them will cover in separate session, but this is there. Now what will happen? The effects on income tax will be like permanent differences. Why? Because it only affects the current income tax expenses, because you will paying lower or higher taxes in current period. In future period you don't need to do anything because there won't be any reversal, there won't be any liability. So you will say that this does not give rise to any deferred tax assets or deferred tax liability. Nothing is being risen. Now it affects only the period in which they occur, which is the current period, and it do not affect the financial income or future taxable income. Okay. Now permanent differences impact for our CPA exam is like this impact only our current taxes, as I told you, and these are excluded from deferred tax calculation. We don't use these for our deferred tax calculation. We will see this in a full-fledged long example.